Let's just start with a broad one if we can. Given what we know right now, in this very moment, how satisfied are you that the Federal Reserve has done and is doing enough?
Well, I think we've done an incredible amount in the past few months. First, starting in early March, we cut the target federal funds rate by 150 basis points to close to zero. We put out forward guidance indicating that we expect to keep interest rates low for quite some time. And of course, we've done enormous actions in terms of providing liquidity and supporting market functioning in Treasury, mortgage-backed security, corporate bond markets. We've got most of our facilities now are open for business, and we're seeing some really big impacts from that. Market functioning has improved pretty significantly. Liquidity is flowing much better, and I feel like we've gotten ourselves in a good position now. We still have work ahead of us, especially around providing for our Main Street program that we're looking to open pretty soon.
John, New York is starting to open up. New York City, the only part of the state that is not open now. As it does, what are you seeing, what are you expecting in terms of the ability of the economy to come back, how quickly, and the same as the rest of the country opens up? What do you think you're going to see now?
Well, I think we're starting to see some initial signs of what that looks like, and looking at all this high frequency, very granular data that all of us have become experts at. We're seeing people willing to travel a little bit more. We're seeing retail sales pick up some, especially in areas where the restrictions have been lifted. So I think we're starting to see some signs of increased economic activity and returning to people spending money and being willing to travel and stay at hotels and things like that. I think one of the big challenges for the New York area is that tourism is such a huge part of our economy. Whether you think about traveling to visit not only New York City, but New York State and the region, and obviously entertainment and all the cultural attributes that the city offers. So I think that that's going to be an area that the recovery may take longer. I see construction and manufacturing as areas where we may see return to better economic conditions sooner. But we'll be watching this data very closely and carefully.
John, as you go from shutdown to reopening, can you talk to us about how policy needs to evolve in line with that and how objectives at the Federal Reserve might shift?
Sure. And, over the past couple of months, as I mentioned, we've really been focused on making sure that credit is available to households and businesses. And that's what our facilities have been really about, making sure that markets are functioning, there's liquidity out there, and that we're seeing credit continue to flow to small, medium, and larger businesses and households and state and local governments. So that's really where our focus has been, and that's where it'll continue to be, because I think that's the real issue for us, during the pandemic phase and as we recover. Obviously, we're also very focused on, monetary policy. How can we best, provide guidance about our future intentions around policy? How can we best shape the use of our tools to support a very strong economic recovery and getting back to where we were early in the year, because that's really where I see our objective. Get the economy back to the kind of conditions where we had close to maximum employment and price stability, which was just a few months ago. So that's really where I think our focus will be.
One of the issues is who's going to be around to reopen once we finally do. And the chairman has talked about the problem of transitioning from a liquidity crisis to a solvency crisis. Where do you think we are on that spectrum, and how worried are you that we're going to have a wave of bankruptcies in New York and around the country?
Well, I think what we need to do is address both the liquidity issues, which of course we've been very focused on with the support from the U.S. Treasury through our facilities, and obviously on our own with monetary policy. But we also need, alongside that, fiscal policy that can provide income to households, to state and local governments, to other hard-hit areas. So I think it's really the combination of liquidity policies, funding policies, and programs, and also making sure that fiscal policy is helping support not only small and medium and large businesses through this period, but obviously households, nonprofits, state and local governments. So it really takes all of these coming together to deal with this range of issues. Hopefully, we'll by providing credit and availability of credit through this period, it will help businesses get through this period and be well positioned to start opening their businesses and rehiring their employees and getting back to work. That said, the virus is driving this. We're really being following how that the pandemic evolves and how that improves, and that will be really, I think, the important driver of how the economy recovers.
In terms of designing fiscal policy going forward, former Fed Governor Kevin Warsh said yesterday that what we're seeing is a supply shock and you should have policies that address that. Most economists seem to think it's a demand shock. What do you think?
Well, I think I'm an economist, so of course I'm going to talk about supply and demand. I think it has combination of both of supply and demand. I think in the near term, over the next year or so, I really do think that the predominant effect is going to be on demand, even though it obviously has major supply effects too. That's why we're seeing inflation coming in so low, and I expect inflation to actually be low over the next year or so, and because the demand effects will even be even larger than some of the supply effects. I do think that the issues that policymakers need to think about, especially in terms of legislation and things, is really how to really put our economy on a long-term, strong, sustainable path. That's an issue not for the pandemic stage and not for right now, but really, I think, a focus for years for the next few years.
John, you've talked about market functioning, and quite clearly you've kept this market wide open for corporate issuers for a whole host of reasons. Do you see it as a role of the Federal Reserve to keep this market wide open for the Treasury to come in as well and continue doing fiscal stimulus?
Well, I think that really depends, like I said, on what happens with the virus, what happens with the economy. And I think that the role of fiscal policy will really depend on how the reopenings roll out, how the economy shows signs of recovery, and what's really the best targeted policies.
Well, I guess what I'm asking, John, is what is the Fed's role? What is the objective? If you have basically an explicit objective to keep this market open for companies to come in and fund themselves, does that carry over to the Treasury as well?
In terms of carry over to the Treasury, in terms of which
in terms
role?
Of keeping the Treasury market open for them to come in and fund themselves?
Sure. Well, I mean, the U.S. Treasury market obviously is the centerpiece of the global economy, and all other fixed income markets price off that and related to that. So for us, a very essential role for us that we've been very focused on is making sure that the Treasury market and all the associated markets around, including mortgage markets and others, are functioning well. And that's what our purchases have been really aimed to do, and that's what we've seen happen. And that's really, I think, a critical component of making sure that credit continues to flow to households and to businesses.
I know that it's kind of hard, John, to put together a forecast right now, so I wonder if the Fed is actually going to follow through on June 10th at the next meeting with the idea of the economic projections and the dot plot coming back. Are you really going to do that? And if so, what numbers would you plug in terms of GDP and unemployment going forward?
Well, as you know, Mike, we're right in the early days of working on our forecast for the upcoming FOMC meeting and doing a lot of analysis. And I agree with your premise that one forecast or your baseline forecast is not nearly as informative today as it would be in normal times. So we're really focused not only on coming up with what we think of as a reasonable forecast, but also thinking seriously about what other scenarios could happen, whether more positive or potentially worse. And so really, I think the focus is not just on understanding what your baseline forecast is, but thinking about what the range of scenarios that could happen and how we could best position policy in terms of that range, and really think about this in terms of a risk management. But my expectation is we will be we're able to publish forecasts, prepare forecasts. We have an outstanding team of economists here in the Federal Reserve who this is what they do every day. And the most important part of this is we're kind of having to do this with a lot of new data, a lot of this high frequency, data from social media, from tracking how people are driving, and all of that. And that's a really new part of how we're approaching thinking about where the economy is and where it's likely to go.
Yeah, I don't want to suggest that that's easy. We all know it's difficult, John. I'm sure you've got a tough time coming up with those forecasts in the next meeting. A lot of people are focused on your next moves on forward guidance and specifically yield curve control. You've talked about the Treasury market functioning. Let's talk about Treasury pricing. Do you see yield curve control as a tool to complement calendar-based guidance in a way that Vice Chair Clowder suggested in the last week? Or do you see it potentially as a tool to shape longer rates? Which one would it be for you, John?
Well, I think we have a lot of options in terms of our toolkit. Whether, we've used obviously forward guidance of different types in the past. We've clearly used, asset purchases to affect financial conditions in the past. And the yield curve control, which has now been used in a few other countries, is I think, a tool that could potentially complement forward guidance and or other policy actions. So this is something that obviously we're thinking very hard about. We're analyzing not only what's happened in other countries, but also how that may work in the United States in the context of the U.S. economy. And really our focus, as always, is to use all of our available tools to best achieve our maximum employment and price stability goals. So we're going to think through that very carefully and come to decisions over time.
Yeah, John, I think there's just a lot of confusion in fixed income markets right now, just from people we speak to every day, on the potential of yield curve control and where it will be focused. Could you set expectations for us? Do you think the focus should be on the front end to anchor rates and supplement calendar-based guidance? Or do you think you can do things on the longer end? Quite clearly in Japan, it's a different market. In the JGB market, they can do something on the 10-year. I'm just wondering what you think about in terms of the longer end of the curve here in the United States and what you can do with yield curve control.
So, these are issues that we're, obviously studying very carefully and we'll be discussing, as a group. So I don't have anything that I can say about what will or will not happen. But really, my view is that the focus is always on just how do we best use the tools that we have? How do we best use whether our communications or our guidance? How do we use whether it's a balance sheet or other actions that we take to achieve our goals? And it really depends on how the economy is likely to evolve. And right now, there's just a lot of uncertainty about that. I think we're kind of in a good place in terms of maybe we're near the bottom in terms of the economic downturn, and hopefully we'll start seeing improvement in coming months. I expect to see a pretty significant rebound in the second half of this year. But really, I think the answer to your question is what's the right policy response and policy actions will depend critically on how the economy is performing, not only right now, but which path do we see it on in the coming months. And right now, that's still a pretty unclear picture. I think we're going to get a lot better information over time, really, about have we seen the trough and are we seeing what kind of rebound and recovery are we seeing?
Before we let you go, I got to say, even though that it's unclear going forward, have you imagine what it's like on the other side? Because I know you think about things like this. When we came out of the great financial crisis, potential growth was lower and around 2% or a little bit less. What do you think potential growth is going to be when we come out of this? And then I want to follow up by asking, are we in sort of a de facto Treasury Fed accord again, in the sense that you're going to have trillions of dollars in loans out at zero or very low interest rates that would really be crippling if rates went up, especially to the U.S. Treasury? Are you going to be stuck keeping rates low, even if you don't want to, for a very long time?
So, Mike, in your first question, it's hard enough to forecast where the economy is going to be going over the next several months or quarters. Forecasting where potential output will be in the next several years is even harder. Obviously, that's a major area of concern. We really want to make sure that those businesses that exist today and households who are able to get through this period, and we don't have lasting damage to the economy, lasting damage to our economy's potential. So that's really the way I view it is the policies that we're taking, the actions that Congress has been taking are really to try to not only minimize the spillovers from the pandemic on the economy, but to minimize the longer term damage to the economy. In terms of your second question, the Treasury obviously is issuing an enormous amount of debt due to the various spending programs that have passed. But there's also an enormous demand globally for U.S. Treasury securities, especially given a lot of the movement away from riskier assets. So, we have not seen any signs recently of a shortage of demand globally for U.S. Treasury securities. Markets have absorbed that increase in supply very effectively. Rates are still very low. So this is not a situation where the Federal Reserve is some way constrained or limited in what we're doing because of what's happening in terms of the issuance of debt securities by the U.S. government.
Before you go, just one quick follow-up very quickly here to something you said about a trough. We're opening up again. Do you think, barring a second wave of the virus, that we have seen the worst now?
Well, it's hard to say because of the data we have is very incomplete. Like I mentioned, we're looking at a lot of little indicators. We're going to get an employment report for May to give a bigger picture there. We'll get some more data, over the next few weeks and months that I think will help us understand that. But based on what we're seeing now, I think we're pretty close. Maybe May or June will be the low point right now based on what we're seeing. But let's just not forget, this is an extreme decline in economic activity, an enormous hardship for people in this country. So even if we're starting to see perhaps a stabilization there in terms of the economy and maybe a little bit of a pickup, we're still in a very difficult situation.